Basic observations. A long-term uptrend was reversed by a sharp correction. The downtrend has paused in a horizontal range. Since this is a Forex chart without readily available volume, it will be a good example to practice examining price action alone. The horizontal range's lower boundary is the site of some unusual short-term price action, as seen with the candles over the last 2 weeks. A bull hammer's bullish context was immediately built upon, with the next candle closing above its high at this key support range. However, the next 2 candles instantly ended an early upswing by closing lower, but not low enough to neutralize the bull hammer, by closing under the bull hammer's low. This led to volatile trading and does make some sense when taking into account the medium to long-term context of the sharp reversals. In late May and last November, volatility is still present, but a bullish advantage is regained as support holds. That is why the 2 red candles on June 12th and 13th, not closing below the lower wick ranges of several past upswings, is a vital observation. Even though there was no volume on the chart, the minor uptrend was moderate to weak, as there were often a few red candles that easily reversed the uptrends back to 1.00, otherwise called parity. Parity on a Forex chart ends up being a significant level without necessarily always running through swing points. It is similar to the significance of a stock's IPO price. 1.00 on a Forex chart is a nice round psychological number similar to 10, 50, 100, and 1000 on stock charts. There was also additional bearish context from the long-term downtrend originating from last November. In late July, a classic long-term bearish continuation developed upon breaching the horizontal range's lower boundary, focused around 0.98 to 0.97. which is where resistance is concentrated for the current uptrend. During the break under 0.97, there was also shorter-term neutral to bearish price action, temporarily supported with the resting phase of 3 methods falling price action, that completed at the start of August. Another strong bearish reversal spikes down as the 0.97 to 0.98 range reverses rolls to offer firm resistance. So far, the case study has avoided marking the chart to more strictly focus on observing general price action outlines. Now, with the addition of markings, the horizontal resting phase in the long-term bearish continuation is clearly seen with an upper boundary around parity from 1.03 to 1.0185. Then a lower boundary ranging from 0.9820 to 0.9670. Additional bearish context is also shown by a failed inverse head and shoulders. Its neckline range is by no coincidence at such a major area, since chart patterns naturally concentrate around significant ranges. From March to May, there was an overall bullish range that inclined slightly to blur the line between a triple bottom and flat bottom. Flat bottoms with more than 3 upswings are just a name. They, like double bottoms and triple bottoms, can also have upswing points that aren't perfectly horizontally aligned. This support range was also part of another pattern that is revealed to be a large descending triangle, to add extra resistance potential to the 0.98 to 0.96 range in the event of a major recovery in the future. A failed descending triangle's support base extends from a less strict triple bottom to an overall flat bottom for a range of support in the upper 0.70s. Depending on which downswing points are used, the failed descending triangle could also be enlarged. In any case, the gradual uptrend began to accelerate, And as usual, there is a normal flattening of price action after the steep uptrend line is crossed. This also happens to be on the approach to the major resistance range around parity. 1.00 is temporarily recontacted to re-enter the previous major horizontal range. This demonstrates the uptrend was quite strong but not strong enough to overcome the wider resistance range. The downtrend lines from the earlier successful descending triangle continue to be useful as trading slides down onto them. Another case where descending trend lines are still quite useful after being crossed, due to being part of a clear pattern. Some double bottoms even form off their supporting influence. Another range-bound phase. Another bullish break, but the chart is still struggling to return to parity. It was not a straight path back over parity, but it has been reached once again. Along the way, there wasn't just constant pressure against the lower 0.9820 to 0.9670 range, but also a stable upward channel that formed off the inclined right shoulder of a failed head and shoulders, with double shoulders. Bullish context was strong, but a strong enough bearish reversal took place just above parity, in the form of a large double top that conveniently reuses the 1.03 to 1.0185 range as its lower boundary. Familiar range-bound trading gives way to an incredible start to 2016 that sees a sharp bullish reversal form on a previous downtrend line that still shows influence. These downtrend lines are quite unique, as it is less common to see downtrend lines have upswings on them. This would be more common in a downward channel. It is rare with longer-term downtrend lines, even if they are part of a major pattern like a descending triangle. Speaking of channels, there isn't exactly a downward channel, but a newer downtrend line that is on the same approximate trajectory. It directly marks the flatter middle phase of 3 methods rising price action in late June, around the 0.75 to 0.755 range. It would be a bit of a stretch to say there was an inverse head and shoulders, but an outline resembling a large reversal is revealed. Within it, there is a fairly uniform decline, almost like a strict parallel channel. In early 2015, there was also a minor reversal range to form a triple bottom, but that was a minor detail in the bigger picture. A simple support level from the 0.6820 low of the last major upswing was so accurate it nearly marked the exact lows of the current uptrend's development. The middle of 3 methods falling price action around 0.72 marks a firm resistance range in the short to medium term to halt the developing uptrend. A noticeable incline is present for a potential ascending triangle. Multiple trend lines are drawn since even if there was volume on the chart, it is useful to have several trend line variations. As seen with other examples, some swing points will not have a trend line touch the real body of reversal candles even if there is high volume. Conversely, candles with low volume may not always have their wicks just barely touch trend lines. Compromises are often made to accommodate more swing points when analyzing potential patterns. The potential ascending triangle outline is almost at an end. A major move is coming very soon. Since it is an ascending triangle, there is a bullish bias. A nerve-wracking end, but the triangle completes for a strong break over 0.72, where there is still a minor pause to establish the new highs with some 3 methods rising price action. As seen before, there is flattening of the trend after trend lines from the pattern are crossed. Trend lines can be adjusted or combined with newer trend lines, such as in this case where new formations are identified. These include the current uptrend that is almost forming an upward channel. Also, like a descending triangle, the ascending triangle is a continuation pattern. So the triangle technically starts near the end of May to continue the bullish reversal from mid-March. Like in other examples, the main reversal's trend lines are also in line with the theoretically correct triangle in a continuation context. It doesn't matter how the triangle is defined here, though to be strictly correct, ascending and descending triangles continue but do not reverse trends.